And here we are, just about 3 minutes into the open of the trading day. You do have stocks slipping just a bit, but really the story of the last several months in the market has been this massive outperformance that we've seen in just a small handful of tech stocks here, really largely driving the direction of the markets here since the start of the year. NVIDIA, of course, leading the way, a lot riding on the sector's rally. Here to break it all down, we want to bring in Matt Miskin. He is John Hancock Investment Management's co-chief investment strategist. Great to see you here. So when we talk about the massive outperformance in tech, we've got the 10-for-1 stock split from NVIDIA here today. And I think there really has been this refocus on the AI trade. Matt, are you at all concerned just about the concentration that we're seeing in the market and what risk that might pose here over the coming weeks and coming months?
Well, it is certainly historic in nature. The market has never been this concentrated ever before. So the 33% or so of the S&P 500 is just in the top 10 stocks. Things could be worse, though, right? Because these companies are printing money in terms of profits. They've got great profit margins. They've got great balance sheets. They're the highest quality stocks. Right now, the market is being driven from the quality factor and the momentum factor being married together. That isn't the worst thing. You know, in the tech bubble, these companies weren't making money. They did not have solid profit margins. But for us, they are getting rich. They are getting expensive. We are moving down in cap. You don't have to go far. Mid cap or even $100 billion market cap nowadays feels more like mid cap because of these $1 trillion companies. But we're looking for cheaper options, a little bit down in cap. We're still avoiding small, but there's valuation opportunities. You just don't have to go far to find them.
Matt, even when you look at the valuations on some of these trillion-dollar tech giants, I mean, Apple over $3 trillion, NVIDIA close to $3 trillion, can the argument be made, given how much potential they have in free cash flow and earnings over the next decade, these stocks still might be very cheap?
Yeah, they're going to grow into it, over time. And the AI, narrative, we think actually is one that is going to be a powerful force for the economy. The U.S. economy just can't grow through government fiscal stimulus forever. We can't just, provide more and more stimulus. And the Fed also is relatively restrictive, but it's going to be hard for the economy to grow without such great support. And we think productivity is going to be the key engine of growth. So what is productivity? It's basically GDP divided by number of hours worked of employees. Well, AI helps people work less. It's all about getting more done with less work. And we think AI is going to be a huge part of that as a secular theme. We believe the best earnings engine in the world is technology. We've been overweight that for the last 5 years. We are still overweight it as we go throughout the course of 2024.
All right, Matt, let's move from AI to another piece of news that's certainly top of mind here for investors, and that's going to be the CPI print that's out on Wednesday. We've also got the Fed decision following just a few short hours later. I'm curious just to get your perspective on the significance of both of those things happening within the same day, maybe what that's going to tell us about should we be expecting some increased volatility as a result?
Absolutely. I mean, you couldn't script this any better in terms of two major market moving events on the same day. CPI days are always ones where volatility presents itself. And then that Fed meeting right after that is pretty wild. So, I mean, for us, inflation data continues to show relatively strength in the housing market. Shelter or housing puts up about 2/3 of the CPI numbers, and it's not slowing. We're not seeing it slow that much in terms of housing data. So that's going to stay relatively firm in our view. And then the Fed might, Powell has been dovish at nearly every opportunity he's had. He's kept, in essence, this inflation impulse alive in our view. But in terms of the summary of economic projections, where they write down how many Fed rate cuts they think in 2024, that might not be 3. It might be 1 this time or none. And the market might not like that. The cuts or forecasting of cuts as forward guidance has been great news for the market. Markets loved it. But if the Fed isn't going to be as supportive, we think that could create volatility over the week. We're looking for a stronger dollar, a flattening of the yield curve, and maybe actually a risk-off bid in markets over the course of the week.
So, Matt, what's the average investor to do here? Should they assume no rate cuts, 10% market correction, sell NVIDIA?
Yeah, I mean, there's three suggestions right there. Right now we're just looking at high quality income, about 5 to 6% as a really good opportunity in portfolios. Our view is income is going to be a bigger driver of returns. we're locking in 5 to 6% in high quality income for the next 5 to 7 years. And we think if you get that done and then think about other things after that, that'll situate you well. Equity wise, we are in the quality part of the market, and that AI name is a part of it. So the quality factor across global equities is what we're looking for. High ROE stocks, holding stocks. We're not overweight, and we're underweight smaller cap, less risky. We're underweight international. We're overweight U.S. large cap, mid cap, and quality. Be patient, get income, be paid to wait, and then wait for better opportunities. As we think at the end of the year into next year, we're going to be presenting a better valuation entry point for markets.
Matt Miskin, Hancock Investment Management, Co-Chief Investment Strategist. Always good to see you. Talk to you soon.